Please understand that any advice in today's session is of a general nature only. Your personal circumstance, any advice in today's session is of a general nature only. Your personal circumstances have not been taken into consideration. Let's go forward. What we're going to cover today, like I said, trends. We'll begin first with a crash course on essential knowledge. It's very important that we cover the basics because as we go, we will be covering more and more advanced concepts. And as the saying goes, you can't build a strong house without a strong foundation. All right. So we're going to cover a quick introduction to different trading concepts. We'll move on to the guts of it, looking at trends, defining them. We'll also have a look at the different types of trends, and we'll put it all together with a very rudimentary approach. I say rudimentary with a grain of salt, guys, because peak and trough analysis, or in other words, peak and trough progression, this one here, it's a very, very important concept in technical analysis. All right, it's one of the building blocks, one of the foundational blocks in really what this whole sphere is. I'll close my soft phone off. There we go. We don't need to take any calls now. All righty, so peak and trough analysis, we will tie everything together and put it all onto a practical demonstration towards the end. So let's get into it. Before we do, of course, we do have our Admirals VIP live trading sessions every week. The idea here is so that you can come to these weekly workshops, gain an understanding of the theory, and then on the Wednesdays, come along to our live trading sessions. We welcome everyone. If you want to be a day trader, a scalper, a swing trader, a position trader, it doesn't matter. You're all welcome. It's a great forum to share ideas. And we've thrown in a little bonus this time, so you can actually request your favorite charts for our special guest, Zoltan. So what he'll do is he'll analyze them real time and apply technical analysis rules, his approach to finding or really analyzing if the charts are worthwhile. Of course, not advice, all general. Alrighty. Now you can ask questions as well. It is exclusive for clients. So if you're interested, contact your account manager. And I think that should be about all we'll cover quickly. Admiral Markets, I'm sure many of you already know who we are. We are a broker here in Sydney. We offer very reliable executions and competitive spreads, of course, and we're licensed to do business here in Australia. All right, so that's the plug all sorted. Let's get into the guts. So what we're going to look at first is a crash course on essential knowledge. And we'll start first with reading price quotes. I will presume that a lot of you already know this, but for those of you who don't know, very quickly, ask price, bid price. You might hear these words thrown around. In other words, they just refer to our buy and sell prices. On the platform, I should say, they will outline, MetaTrader does outline the prices in the column of Market Watch. So you can see clearly which is the bid, sell price, and which is the ask or buy price. You'll also see the prices are in twos. All right, guys, apologies for that. I think our local internet, local NBN, it's just not handling everyone working from home these days. So I will resume where I left off. I'll just give my little slides a refresh. I appreciate your patience, guys. We all know the joys and wonders of working with the internet and the connections. There we go. All righty. Because I want to share my screen. Cool. All righty. So here's my screen again. Just let me know if you can't see anything or if there's any issues with the connection. Drop me a message in the chat. All right, let's hope this doesn't drop out again, but we'll continue on. All right, so ask bid, if we subtract the two, the buy and the sell prices, we'll actually have a small difference, which is our spread. Okay, so that's essentially, we could look at like a brokerage fee for a lot of instruments because there's no commissions when you trade on these on the Admiral's account. Now, the next step is the percentage in point, or affectionately known as the PIP. For those of you who aren't aware what a PIP is, it's simply how we measure price changing. Okay, for any particular investment or trading instrument, it's how we determine what price moved, how much price moved, I should say. So a little secret that I'll give you, Forex enthusiasts, for many instruments as well, you might see this same coincidence, and that is on the platforms, they'll actually have a small digit at the end. So this tiny little one, this small digit to the left-hand side, this is our pip position. Okay, so this is where we measure the price changing. We could also call it 0.0001. Okay, now this is specifically Forex. Like I said, it may apply to other instruments as well. But as you become more fluent and confident on the platforms, you'll easily be able to pick up which is the pip position. So where is our price increment measured from? All righty. So that's the pip. Like I said, you can see it very easily on the platform. Another one that you'll hear thrown around a lot throughout this course is bulls and bears. For some of you who may have heard them, or you might have heard this analogy, interesting way to remember this, okay? Because all they refer to is the direction of price. Price went up, price went down, bullish market, bearish market. So the way we can remember this is think about the way a bull strikes. All right, it's going to come running with its horns at the ground, striking up. And what about a bear? It's going to stand up and bring its claws down. All right. So that's a fun little bit of trivia you can bring up next time. If you do like watching your news or watching YouTube videos, you'll hear those words thrown around a lot as well. Okay. But I will use these words interchangeably. So bull, maybe an up candle, a candle where the price is increased, or a bullish market where the market is looking optimistic for buyers. Okay, bears is just the opposite. Price went down, or a price where, or a market where participants are more negative on price. Okay, now the final little leg here is long and short. You'll also hear these thrown around interchangeably with buy and sell. I won't go into the very technical definition. I'll give you the summary. For us to take a long buy, a long position, we're simply taking a position to profit as price rises. Now, a short sell, again, very, very simplified, taking a position to profit as price falls. There's a lot more to it, of course, but this is something we can talk about later, and you will learn as part of the CSC Traders course that we offer and through our educational articles as well. All right, so that's almost all the basics now. Now, I want to give an introduction to technical analysis, considering this is what the whole course is about. So to clarify exactly what we're talking about, the art of technical analysis, as described by Martin J. Pring, a renowned technical practitioner, is technical analysis is to identify trend changes at an early stage and to then maintain an investment or trading position posture until the weight of evidence indicates that the trend has reversed. Now, I've boldened a couple sections here I found very, very important to draw your attention to. Identify trend changes at an early stage. Okay, remember this one because we will come back to this later. And also the weight of evidence, or taking that trend, taking that position until the weight of evidence indicates that the trend has reversed. Now, the key part here is the weight of evidence. All right. Now, Mr. Pring has got a great book. It's called The Technical Analysis Explained, 5th edition. He goes much further in detail. But one thing that stuck out for me that I wanted to share with you all is this quote. All right. Technical analysis deals in probabilities, never in certainties. All right, let that sink in. Now you might, this might cause some dissonance for some of you if you're thinking, well, hang on, isn't trading all about being right all the time? Well, not necessarily. Okay, part of trading, especially trading psychology, is actually understanding that losses are inevitable. Okay, even the best traders out there will make losses at some stage. The risk is always apparent.
But if we take what Mr. Pring is saying, Martin's saying here, all right, we can understand that, hey, it's not all about becoming a 100% win rate trader. All right, that might be impossible. Instead, we want to aim for the weight of evidence. All right, this is what we're looking for when we take those decisions, make our management decisions of open positions. All right, keep this one in mind. We'll come back to this and revisit this plenty of times throughout this course, but it's a very important concept. Now, technical analysis, what we're actually doing is we're using a variety of tools. All right, so it's not just someone looking at charts and kind of saying, this is where we buy or sell. There's a bit more to it. We might be using indicators. We might be studying market structure, pattern analysis, price action. Okay, all of these tools, we'll call them, will be covered further on. Okay, we'll spend whole sessions just dedicated to indicators and market structure, patterns especially. That one will take 2 sessions. So there's lots to talk about. But one thing that I also want to draw your attention to is the technical analysis, the art of what we're doing is we're really looking at studying psychology. Okay, now again, I'm going to bring up Martin or Mr. Pring's quote. Another one based on the assumption that people will make the same mistakes as they have in the past. All right. So think about the way price is formed, or really the market's formed. What's it made up of? It well, it constitutes people. Right. Yes, there's organizations. Yes, there's big institutions, hedge funds, whatever. But what are all these corporations and participants made up of? Human beings. So technical analysis, it offers a way for us to gleam into psychology. And when we analyze the markets using technicals, we're really looking to play on the psychology of others. Right? This is a big, big quote as well, based on the assumption that people will make the same mistakes as in the past. Human nature to a core. Okay, I'm sure many of you can relate. It does take some time to break a habit, to correct mistakes. And I also found this cool little picture I thought succinctly sums it up. You've got a human brain, an outline, and what's the brain made up of? Money. All right, this might represent greed, something that can cloud our judgment, make us make these same mistakes as before. All right, so very powerful image, guys. But that's what we're trying to do here with TA, technical analysis. All right, we're using tools, we're going with an evidence-based approach, and we're looking to play the probabilities, understanding what we're doing, basing our decisions on the assumption people make the same mistakes. Human nature. All right, so we're now going to get into the technical side of things. We're going to actually discuss the starts or the beginnings of the Dow theory. All right, Charles Dow, actually the founder of the Dow Jones Industrial Index, his theory, or part of the theory, it constitutes the wave theory, right? The fact that price moves in waves. Think about like a beach, right? You've got the waves moving in as the tide grows larger. Okay, the waves will become bigger and bigger and bigger. Likewise, the other way, when the tide turns and it starts to become a receding tide, what will happen? Well, the imprints on the sand will move further and further out. So if we translate this to trading, if you think about the way that a wave makes its imprints on a beach, we can think of this for price. So a price, let's say it makes a move up, and then it might make a move down. All right, let's say this is an uptrend, so it continues up. Now, impulse and correction, where we see these guys fall in is, well, this movement up, we would call the impulse, I'll draw a line to it. Okay, and the movement down, well, in this case for an uptrend, we'll call it a correction. All right, so we understand price moves in waves. We've got the impulse, we've got the correction, the move up, the move down, vice versa for a downtrend. Pretty easy stuff, I hope. Now, if you've got any questions of what I'm saying, there is a Q&A box as well. Feel free to chat there. If you put it there, at least I make sure I don't miss it. The chat box is a bit unreliable. So what we're going to have a look at is applying this into the definition of a trend. All right, so we understand we've got impulse, we've got correction, move up, move down, move up, move down. But what constitutes a trend? Well, we would define a trend. We'll start with an uptrend, prices moving up. We'll define it as a sequence of higher highs and higher lows. All right, think about that. Downtrend is just the reverse, a sequence of lower highs and lower lows. So I've got a couple of excerpts here. I've used a line graph just to make this very, very apparent. You can see for this uptrend, put up here, we've got the market moving. We've got an impulse. We've got a higher high set. Okay, now the price hits the ceiling, it turns around, it retraces, and it finds bottom here. Okay, maybe it finds support. Whatever happens, the market turns around. So at this point where the market has found bottom, we would call this the higher low. So here we go, we've got the first part of our sequence, but we still need to continue on ways up. So I'll just redraw this line. We've got another impulse, price moves higher. We hit the ceiling. We set another higher high and the market retraces. Again, we set the higher low and continue. So this is how we define an uptrend, a series of higher highs, higher lows. You can easily start drawing this, which we will do on the peak and trough progression. So higher highs, higher lows. Now we reverse that for the down. Okay, you can see downtrend, we've got the market price moving down. We've set here I'm getting muddled up. We've got to go a lower high at this point here. The market tries to move back, fails. It sets a lower low. Wait, I'm getting these ones mixed up. Lower low, lower high. It is late in the day. Lower low, lower high. There we go. Now the market continues on its pathways down. The bulls try to regain control. They fail. At this point here, we've set another lower low. Now the bears take back control and we push all the way back down. At this point, we set the lower high. Pretty simple stuff, I hope. All right, uptrend, downtrend, higher highs, higher lows, lower highs, lower lows. All right, now we understand the definition of an uptrend, downtrend. How do we use this? Well, first of all, if we're looking at different time frames, what you're going to find is that this definition of trends, it applies to all time frames, whether you're a minute chartist, whether you're a hourly chartist or a monthly. It doesn't matter. It will apply to all. Now, one thing that you'll also hear from Mr. Spring is human nature is more or less constant. All right, so whether we're looking at the monthly, the minute, the hourly, the concept of human nature will more or less be the same. People tend to make the same mistakes, whether on a 1 minute chart, an hour chart, or a monthly chart. The key difference may be the magnitude. And when I say magnitude, I mean the fact that when we look at the higher time frames, generally speaking, trend reversals, price breakouts, they tend to be more significant on higher time frames. It's not to say they don't happen on lower, but on the higher ones, generally speaking, you've got greater magnitude. Buyers and sellers are locked in a fierce, fierce battle on the monthly charts versus, say, the minute charts. All righty. Take that with a grain of salt. It is technical analysis theory after all. And of course, make sense of it as you do. Now, a great way to do it is practice on some demo accounts. You can actually change those timeframes very easily and have a go at looking for these trends. And I'm actually going to go through this now, the types of trends. So I'm now going to draw on another, let's call it a fundamental concept in technical theory, which is the market cycle model. Now, the market cycle model, it may sound complicated. All it really says is there's three major types of trends, three important kinds, if you want to call it that. We've got a primary trend, we've got a secondary or intermediate trend, and we've got the short-term trend. Now, there's also two more, which I'll bring up afterwards, but we'll focus with these three. Okay, so what are we saying with the primary, secondary, short-term? Well, this will depend on the timing. And again, take this all with a grain of salt because timing may vary depending on the instrument. But so you understand the concept, the primary trend, we could class this one as, say, the longer term trend. We'll put this into layman's terms. Longer. The secondary or intermediate trend, we could class this as the middle. And the short-term trend, well, it's in the name. It's the short term. All right. Now I've given you the definition. Let's actually draw this out on the next screen. Now you'll have to excuse my messy drawing, but I'll try my best with a mouse. Hopefully in future we can get the this tablet of ours working. So what we're going to do is I'm going to draw on here in red. Right here, red equals primary. And what this one might look like is a big, long shape like this. Okay, now I'll quote Martin Pring's book. He does give a approximate time frame of, let's say, 4 years, up to 4 years. Again, give or take it with a grain of salt because it would depend on the instrument you're looking at. Best way to do it is through practice, of course. But this is the primary trend. You can see it's a big, long, sweeping trend. All right, spans over, let's say, many number of years, many number of trading sessions. Now I'm going to do here in blue. I'll draw up the secondary. We also call this one the intermediate, secondary. And this one, it may look something like this. Okay, so we might have the up here, follows down. Alrighty, the market tries to break up. It's forming higher highs, higher lows, higher highs, higher lows. And it might hit top here, form a double top, for example. And then we'll start the sequence for downtrend. Okay, very rough drawing, but this is what we might class as the intermediate. So we could see that the primary uptrend, this leg here, it's actually formed up of a whole range or a sequence of higher highs, higher lows, uptrend. We get to the other side, we get to the downtrend sequence. What do we see? Well, now we see the downtrend sequence. Higher, oh, I'm getting this mixed up, lower highs, lower lows, lower highs, lower lows, etc., etc. Now we also have the short-term trend. Okay, short term. I'll do this one in green, make it very, very obvious. G, I'm gonna write here short term. And this one, we might see, it looks a little bit different, it looks a bit more crazy. So we might see it here, something like this. We've got the high, it'll come down, we've got hit the bottom, we might form a double bottom, it might pull up, form a high, peak out, lower lows. All right, I'll try to draw this one as quickly as possible. So I just want to show the definition more so. Okay, again, very rough drawing. Okay, I think you get the point. It's a lot more chaotic. It forms the uptrends and downtrends within the secondary intermediate. So in all honesty, we could say that it's breaking down the price. All right, an uptrend on the primary, we could say it's upper high, the uptrend sequence for secondary. For the short term, well, same principle applies. On the secondary, when we say the uptrend, we would also see an uptrend sequence on the short term. All right, so you get the gist, okay? You might even come across this term, which we will cover in future sessions, or price being fractal. It's more or less another way of saying that price, smaller time frames form up the movements of higher time frames. Again, very layman's terms there. So uptrends on the primary, the big trend, we'll see that formed on the secondary, and likewise the short term, and likewise and likewise. So this here, feel free to take a screenshot. Again, I'll record this so you'll be able to watch it later. And there's also a great image online that you can download. But I do want to quickly cover the two other types of trends before we move on. So the MCM market cycle model, it also offers two other supplementary trends, the secular and the intraday. The secular trend, we could call this one the extremely long term, again, using very common language there. And we might look at this like trends that span over decades. All right, maybe if you're looking at the Dow or one of those equity markets, you might see it spanning over decades, many, many years, versus say at intraday, which is very, very much a micro view. Intraday trends, we generally class those ones as trends that happen within a day's trading session. Could be minutes, could be hours, could be seconds, who knows? Okay, as long as it happens within the definition, the daily session, intraday, within the day. All right, so that's the primary, the ones that make up the market cycle model. We've got the primary, secondary, the short term. We've got the supplementary ones, the secular, very long term, intraday, shorter, micro view. All right, now if there's no questions, I will continue on. I just need to make sure we're conscious of time. So we'll put this all into practice now with a bit of peak and trough progression analysis. Now, the name sounds complicated. I assure you guys, it's much simpler than it sounds. It's actually taken or draws on the principles of Dow theory. Again, something we'll cover on in, I believe, next or the week after's session. Again, for those of you who joined late, Dow theory, the wave section of it, we're saying that price moves in waves, higher highs, higher lows for uptrend, lower highs, lower lows for downtrend. So we're using principles in Dow theory, specifically this one here, price moving in waves. Now, peak and trough progression, generally speaking, it's a trend reversal technique. Okay, it helps us with, again, going back to the definition of technical analysis, finding trends as early as possible. Okay, we want to use this to identify when a trend structure has broken, trend sequence, for example. So we can see the objective. All right, we're looking to find the points where a rising or falling set of peaks and troughs are interrupted, those higher highs, higher lows. Now, I'll actually demonstrate to you what this looks like with two different instrument classes, just to show you that we can apply these principles to really any market, any chart, as long as we can have a chart. So what we'll start with first is the US dollar currency strength index, the USD, the ticker code is DXY. You can trade the futures contract on MT5 as well. But I'm using very historical data, I believe from many months ago, and we're on the weekly charts. All right, no specific reason. I just used this one because it was open at the time. But you can have a look, have a play around, and actually apply what we're going to go through now to different timeframes. I'd encourage you to do that on a demo. So what we can take a look at is we'll first apply the higher high, high low principle and look for an uptrend. We can actually see one right here. Okay, so let's go ahead and mark out our HH and HL, higher high. All right, we can see market has come from this bottom. It's reached this resistance level. Okay, it's reached this ceiling. It's created a higher high, but it's failed to continue on. Now, from here, the bears were not able to control the market. Okay, buyers came back with force, pushed the price higher. So at this point, we've set ourselves a higher low. Now at this point here, we've hit another higher high. But what happened after this? Well, let's take a look. Make a bit of space. So here's our higher high. Now the market, it's come back down. It's gone through correction again. It's created a higher low, but this time the buyers were not able to push the price beyond our previous higher high. Instead, price has fallen. Bears have taken over control, driven price all the way back down. So at this point, instead of creating a higher high, what we've seen is a lower high. Now, again, we apply the principle. We said the market has hit this bottom section. We'll call this a support region. It's created a bottom, and this time it's failed to set a lower low. Okay, because here, oh, I'm looking at this point. So this point, we've technically set a lower low. So we could see that the price may appear to be in downtrend. I'm a bit apprehensive because you can actually see what happened here. So just keep in mind that what we see here is in fact price moving sideways. We haven't been able to continue the downtrend. All right. We've just applied the very first definition of the trend though. We've seen the wave analysis. We've applied it to the up, to the down. But how do we use peak and trough? All right, let's come a little bit further. And I want to have a look at this region here. And I'll explain the reasoning for this. Okay, we're going to focus on this section of the screen. Now, we're going to start our analysis at this point. Okay, we can see that we've set ourselves a new low. Now, what the market has done, it's come up. We've planted a higher high, higher low. Again, we've just broken the higher high and set another higher low. So we are in uptrend. According to the definition, we've continued. We've gone set another higher high, higher low. We've continued on until we've reached a certain point. We've hit this ceiling. All right, again, the buyers have come up, taking control. We've reached this point. We've set a higher high. And what has the market done from this point? Well, we can see it's come back down. We've gone to set another higher low. All right, at this point, we might be thinking, okay, uptrend might be continuing. Instead, price action did something completely different. What did it do? The price has now fallen. So instead of setting a higher high, we've got the higher low here, and we've now hit a new lower high. All right, a lower low, I should say. I'm getting muddled up here. Lower low. Okay. Now, the way we'd apply the peak and trough analysis is we understand that this whole segment here, we are in uptrend. Okay, according to the definitions we've covered, market is moving up. We are officially in uptrend. What we're searching for with the peak and trough analysis is at what point does the trend reverse? So what can we actually see at this critical junction here? This very, very important point. Well, we see at this point, I'm just going to remove this bit off here. We can see that at this point, the higher low, if we drew a line across, we would see this as the breaking point of another higher low being set. If this point gets broken, if we set a low below this point, well, technically we're not an uptrend anymore. Okay, technically the low below the higher low here is a lower low. So peak and trough analysis, if we can identify the trend, are we an uptrend? Are we in downtrend? We can then apply it to searching for these reversal points. Now, just to demonstrate the power of this technique that Mr. Dow, will give him the credit for it. He started, he let's say established this concept many, many years ago, 100 and something years ago, 30 years odd. He's made this principle and it still holds true today. What it says is at this point, at this junction, where the higher low is broken and we've now set a lower low, then we can see that this set of peaks and troughs, the uptrend has broken. Now at this point, we will be wary. Are we going to continue buying? Well, we might think, hang on a second, the trend is broken. Would we, as CFD traders, would we look to take short trades? Well, again, this is up to you. But you do have the option with CFDs, Forex trading, to take short sells, which basically means we're profiting as the price falls. All right, so why is this important? Because at this point where we've broken through the previous sequence, we have now set ourselves the lower low. We can now observe, do we now proceed into a downtrend? Well, you can see, but let's apply the analysis. So the market retraces, the buyers try valiantly to come back up to the higher high, fails. We set here a lower high. Market turns around. Okay, at this point, we set ourselves a new lower low. Okay, here we go. We can see the sequence forming, lower highs, and you can try the rest here. All right, we see all these points appearing to indicate the previous sequence is over. We are now in downtrend. Okay. Now, actually, this is interesting. I pulled up a weekly chart. I can relate it back to the time frames. We can actually see the weekly. Look at the magnitude of this reversal. Okay. In, I can't say how many weeks that is, how many sessions, but within a certain number of sessions, within a close certain number of sessions, the market has pretty much lost all of its gains that it made previously. Okay, you can see here, or technically here, we've started the uptrend. And at this point, we have come down and actually broken through and lost all the gains. Okay, so you can see time frames, they do apply for all. Like I said, try this out on a demo, low time frames. And remember the principle that we outlined before. All right, it applies to all, but the magnitude does differ depending on the time frame we're looking at. Now, I did say I was going to demonstrate this as well with a different asset class. This one is gold, a precious metal. The ticker code for some platforms is XAUUSD. That's its official name. Affectionately, we know it as gold. All right. Now, I won't go into the wave section. Let's just go right into the peak and trough. So we'll apply what we just used for the dollar index, US currency strength, and we'll apply it to gold. All right, we'll start from this point. We can see here's our low. Okay, we'll call this bottom. Now we've set our higher high. Alrighty, we've come back down, set our higher low. All right, we're in. We are progressing up. I'm just going to cut through the noise a little bit. And we're going to come up to this point. We'll set ourselves a new higher high. Market will turn around. Again, we'll apply the sequence, higher low. Now at this point, the market goes into consolidation. We haven't talked too much about this today, but we'll have lots to talk about in future. Consolidations, where price, let's call it a sideways range. It trades vertically, horizontally instead of say vertically in a diagonal. This is where price is unsure. Maybe it wants to go down, maybe it wants to go up. All right, just to give you a teaser. But in this case, we can see the price consolidates, goes through this squiggle, and boom, it shoots up. All right, we see it hit and set a new higher high all the way up the top here. Higher low, and we get to our critical junction. Okay, this is where we will start to watch. All right, we have set ourselves a new higher high. Now, at this point, where we go into correction, instead of coming down and setting a higher low, what does the market do? Well, the market aggressively punches right the way through and sets ourselves a new lower low. So in one big, powerful move, we've lost those gains and crashed down, set ourselves a lower low. We've broken this sequence. Now, at this point, we're thinking to ourselves, okay, maybe this little, this small movement here, this double top pattern, perhaps it was just a knee-jerk reaction. Maybe we just want to verify, is the uptrend actually broken? All right, well, let's observe and see. So we can see the market structure is broken at this point. All right, I'll just draw this line out. And again, we'll have a lot to talk about with these types of patterns, double tops, head and shoulders. This line, we actually call it the neckline. I'll write it up here. Don't worry if you don't understand, just so you know what it's called. The neckline, this is where the market has broken the structure, the sequence of higher highs, higher lows. We're now in downtrend. But instead of coming and setting ourselves, all right, we've got ourselves the lower high, but we haven't been able to set ourselves a lower low. So technically, we are not in downtrend yet. All right, what does the market do? Well, again, I'll give you guys a teaser because this is, again, something we'll talk about very soon. We come down, market smashes through our junction point, the neckline. It hits, creates a new low at the bottom here. And we come up, we set a lower high, but instead of coming down to create a lower low to continue the downtrend sequence, we instead see buyers return, and they return with force. All right, so they drive the price up. Now this pattern, just get rid of my squiggle so you can see. This pattern here, some of you might know this as the double bottom. All right, we see it's a very nice double bottom as well. It comes, we hit our junction point. Again, this is for the downtrend now. So we've come, instead of setting a lower low, we've come back up, we've smashed through our lower high. All right, at this point here, the neckline, the junction point, and we've come up and set ourselves a new high. All right, but are we in uptrend? Well, it's maybe too early to say. Let's see what happens. So the market then comes back down. All right, we've now set ourselves, exciting, a higher low. But what happens here? All right, the market, we want to see it continue to uptrend, but instead of creating the uptrend sequence, we see a lower high. All right, now what happened? It came back down. It's tested our higher low. This line actually continued from before, and it's smashed right the way through. All right, so again, we can apply the peak and trough progression here because, well, we're expecting, or we wanted to see an uptrend. Our analysis indicates, well, hang on a second, peak and trough progression shows us the market trend has actually broken the previous sequence. It smashed all the way down and created a lower low. All right, so this is an exciting point because what we can see now is if I remove this, all right, we have got here our lower high, continued down, set a lower low. Here we've come back up, not able to break through and push into a higher high and set a lower high. All right, markets continue down. So we've confirmed another lower low. Will the market continue trending downways? We will need to see. All right, but let's apply the peak and trough progression again. We're watching, and we see market, instead of creating the new lower high, lower low, it's come to this junction point. All right, we can see it's smashed all the way through this lower high, and it's now set ourselves a new higher high. All right, so we've just applied the peak and trough progression to half of this chart. I'd actually set a bit of homework for you all and try this for yourselves. When you jump onto the platform, whether it's MT4, whether it's MT5, it doesn't really matter which one you use, try and apply these principles. All right, can you see where we identify the higher high, higher low? Can you see and can you spot where we get to these critical junction points where market breaks the previous structure and the trend is reversed? All right, now practice this. Try to become comfortable with looking at and identifying the trend, the market trend. Have a go at looking at different time frames, because in our future sessions, we're actually going to go way deeper into these patterns, into drawing things like trend lines. I actually touched on it before, but support resistance levels, and much, much, much more. All right, so I will quickly summarize what we've gone through today. Just number one, remember that technical analysis principles, we can apply these to all time frames. Okay, you don't have to be a minute trader or an hourly trader or a monthly. You can be any. Technical analysis principles apply. Depending on the time frame, generally speaking, and the instrument, higher time frames will result in a reversal, price breakout, price movement of a greater magnitude to smaller time frames. All right, like we saw before, we saw a big move up, big move down. If we converted that to a minute chart, well, I guess in retrospect, in what's the word? In proportion, you would see that minute chart reversals, price breakouts, they don't compare in size to the larger time frames. Okay, so remember that one. We can apply it to all. We just need to be conscious of setting our expectations. All right, now the peak and trough progression, we covered this one. It's the most basic method of trend identification, yet one of the most powerful. And we draw on this principle quite often when we look at things like market structure analysis, and also when we look at trend lines, support resistance, chart patterns, the works. All right. So if you become comfortable with this one, it'll give you a strong foundation for us to continue on in our future weeks. All righty. Now, consolidations, I touched on it. I did want to draw this in our summary because although I didn't speak much about these, they will feature prominently in future sessions. Consolidations, we might look at them as price ranges. We're priced as one of these ones. All right, break up, break down, for example. They do play quite a bit when we look at, say, swing trading or breakout trading. So consolidations, we didn't speak much about it today. We will have a lot to talk about in future sessions. And like I said earlier, if you guys enjoy the theory aspect, but you want to see more of the practicals using analysis in real time, we do have our Admirals VIP live trading session every week on a Wednesday night at 7. So you'll have the theory Thursday, you'll have the practicals Wednesday. Bring all of your questions. My colleague Zoltan, he's a professional day trader and specializes with scalping. He'll actually analyze charts, answer your questions real time. And I'd actually encourage you guys to take advantage because this service, the live trading, the open, the workshops that I do, they are all free of charge for our clients. We reserve some for clients that have live trading accounts. But if you're keen, by all means, have a talk with your account manager. We're friendly people. We're all in Sydney. All right. So that's the summary for today. Here's our contact details. Like I said, get in touch. If you think of any other questions tonight that you wish you had asked, don't stress. You can ask them tomorrow to your account manager. We will have them all answered. Don't worry. We'll also have a recording of the session online to YouTube, most likely tomorrow. So if you did miss out on part of it, or if you just wanted to rewatch and kind of brush up on what we talked about before next week's session, please feel free. I will send out the link. We'll have it on our YouTube channel. So if you're not already subscribed, jump on. This is our URL, youtube.com/Admiral Markets. We have a lot of good trading content there. All right. Now, next week, I believe we are going to continue a little bit further with the trends. As the weeks go by, like we said, we will look at more and more patterns, indicators, everything. It's really, I think we've done this a bit differently to previously. We've tried to spread this out and cover each section with as much detail as possible. So I'll hang around for a couple moments, guys. If you've got any questions, feel free to type it to me in the chat as well as in the Q&A box. I'll give you guys a few moments. I'm just going to quickly bring up the schedule for next week so we can all see what we're going to learn. Alrighty, so this here is our website. Okay. So next week, we're going to be looking at the business cycle, Dow Theory. Oh, yes, we're going to tie in a bit more about what we talked about with the wave analysis, uptrend, downtrend sequences. And then we'll go through the resistance, support, trend lines. Take a look, guys, because it's going to cover a lot of different things as we go. Alrighty, we've got a question here from Tony. How do I know what to look for to recognize successful Forex trades? Oh, okay, this is a loaded question. Now, I think the best way for me to answer this without giving any advice would be number one, for a successful Forex trader, or with every successful Forex trader comes a successful strategy. Right, the two go hand in hand. The strategy itself, it differs from person to person. It may differ. Think about it like this. Every trader is different. Your personalities are different. Your risk appetites are different. You might be more comfortable risking less versus someone who's risking more. Okay, so if you're looking at monetary success, keep that in mind. It's a very important concept to remember. Money management, I don't know if we'll cover it in this course, but we will have plenty more in the coming weeks. Now, if your question regards the analysis, so how do we actually identify the successful trades? You remember how we said earlier at the start, when we do technical analysis, when we look at charts, we find these buy or sell trading opportunities. What we're going for here is not necessarily to win every single trade that we enter, but we understand that we're looking for consistency. We're looking to play the probabilities. Okay, we're never playing the certainties, because ultimately, no matter who you are, whether you're yourself, you're Warren Buffett, no one knows what the price will do. All right, I took that quote from the Wolf of Wall Street movie. So no one knows what the price will do. Okay, remember that. So if you're out there trying to achieve a 100% win rate, just understand that number one, that may or may not be feasible. It might not be possible or realistic. Instead, we're looking to strive for consistency. We're looking to aim for the high probability trades. Now, I'd say that that would be most apt for your question. What's a successful trade? What's a high probability trade? The way that we make these trades or we make these decisions is through an evidence-based approach. That's what technical analysis is all about. And like I said before, guys, there's a great book. I've referenced this quite a lot. There's another one as well that I do go. I take a lot of resources, little tidbits from. I'm just going to go all the way back because it's a fantastic book. Keep in mind, this is just a referral, no kickbacks. I think this is just good content. Technical Analysis Explained, the 5th edition by Martin J. Pring. He is a very clever man, and he does talk quite deeply about this concept of technical analysis. All right, we're using an evidence-weighted based approach. So in other words, we're not looking to just look at charts, decide, okay, I'll buy and sell now. We want to use various tools, whether it's indicators, whether you're looking at peak and trough progression, or you're studying market structure, supply, demand, Wyckoff theory, whatever it is, you're using the evidence to your advantage. Okay. Now, again, I think this is a great one to leave on. This quote, I highly recommend write this one down, put it in your trading journals. It's a great ethos to live by, to approach your day-to-day trading with, especially as you're trying to develop a mature trading mindset. So the art of analysis is to identify trend changes at an early stage. Now we want to maintain those investments or trading postures until the weight of evidence indicates the trend has reversed. Okay, the weight of evidence is king here. It's super important because that's really how we get the high probability trade aspect. Tony, let me know let me know if I've got your question there. Before we wrap up, guys, I'll leave you guys with a moment or two. Any last questions before we finish up? But that was a great question, Tony. I think it really relates back to a lot of what we talked about. And I do look forward in future when we do cover these other tools, this evidence-based approach, that we will see you there as well, matey. I think you'll find some good value. You'll enjoy it. Feel free to ask many more questions because, as we all know, we learn through asking. And especially at this stage, well, there's really no such thing as a silly question. All right. So never be shy to ask. Trading is meant to be a fun experience. It's definitely something that will leave an impact on your lives in many different ways. It might even change the way you look at things. Who knows? So it's a great thing to learn, and of course, ask away. So if that's all the questions we have for today, I think we've just about hit 60 minutes or almost 60 minutes. I'll leave it at that. I'll have a recording online for you all tomorrow. And next Thursday at 7, I do look forward to seeing you again for part 2. Alrighty. So guys, I hope you have a fantastic evening. Take good care. And of course, happy trading. Good night. Bye for now.